Welcome to my YouTube channel, Credit and Finance Club, or short for CFC. This channel is to discuss about stuff related to banking and finance. Our vision is to help demystify the world of banking, finance, investment, and basically many of the stuff that we see daily, whether on the news, when we get a loan to buy a house, reading annual reports of companies, and more. Feel free to leave your comments in the comments section below to let us know what other content you would like to see. What we express here is our opinions and is more relevant to the real workplace rather than a textbook. I believe that if you like reading textbooks, then go ahead and read one. But my videos is to help you visualize how this is applied in a jobs context. My friend and I, we are real-life credit analysts who have worked in banks, financial institutions, and that's our full-time job. We are here to share with you some of what we know. I'm sure you have heard about the COVID-19 pandemic affecting the world economy, affecting companies, affecting people's livelihood. The question is, how exactly does this happen? And there is no better place to start than looking through the lens of credit risk. The number of COVID-19 confirmed cases has surpassed 44 million cases worldwide, with the death toll exceeding 1.168 million, while cases continue to rise in emerging markets such as Brazil, Russia, and India. The situation remains complicated elsewhere. Europe's surging second COVID wave and a renewed upward trend in US cases as the third wave threaten to undermine recovery prospects. Globally, around 68% of confirmed cases have recovered. So why is credit risk the way to look at this problem? The best way to understand how COVID-19 pandemic leads to a recession is through the lens of credit risk. Credit risk allows us to trace the route to understand exactly how a virus can lead to economic meltdown. We know that a recession means that the economy is doing badly, companies are not making money, and a larger proportion of companies are incurring losses. Employees are suffering due to smaller bonuses, salary cuts, or in the worst case scenario, being laid off. To fully dissect how the recession is being inflicted on people worldwide, the way to go are to analyze how companies are impacted. Without understanding how companies are affected by the pandemic, we are unable to fully grasp the obvious signs that exist months or even years before a company gets into financial troubles. We are talking about corporate credit risk, which means that the likelihood that one company is going to default on payments to another company. We all know that companies purchase goods and services from one another. For instance, a car manufacturer like Toyota will purchase steel from a steel factory to build its cars. Before COVID-19 came, Toyota would typically enjoy a good steady stream of customers who would buy its cars, and therefore Toyota would be able to use the money to pay off suppliers like a steel factory. However, when the pandemic struck and people stopped buying cars, Toyota sold fewer cars. This means that Toyota would have much lesser money to pay off its suppliers. Money is also used to pay off workers, bank loans, for research and development of new cars, and so on. Credit risk refers to the possibility that in this example, the car manufacturer like Toyota is unable to pay the steel suppliers and default on payments. We will be touching briefly in this video how credit analysts' thought process works. So, what do credit analysts do? I can't say that all credit analysts do the same thing in all companies everywhere in the world, but generally, here's in a nutshell what they analyze. In case you were wondering whether only banks hire credit analysts, the answer is no. Many companies, especially larger corporations, have their own credit risk department. Say a client, which can be another company that comes to take a loan from a bank. The bank's credit analyst would give a credit rating to the client, analyze whether the client has the ability to repay the loan. In a non-bank scenario, however, companies would also give each other loans. These loans are made in terms of credit terms of 30 days, or up to 180 days or even more. This allows companies to make payments for goods and services supplied. Think of these credit terms as loans being made. This is where credit analysts come to assess the amount of credit terms as well as the period. Usually, a credit rating is also given. Take the example of a shipping company like Maersk. It is the world's largest container shipping firm with thousands of ships. Ships need fuel, also known as bunkers, to travel. Maersk would therefore have to purchase bunkers from bunker suppliers like Shell or smaller fuel suppliers worldwide, since their ships move all over the world. Fuel suppliers like Shell would hire credit analysts to determine the quantum of fuel to sell to Maersk. If the analysts deem Maersk as a good paying customer, then they would recommend selling, say, $10 million worth a month of fuel. However, if a tiny shipping company comes to ask for fuel, it is likely that only maybe $100,000 worth of fuel is sold to them, or that company has to pay for the fuel on the spot with cash, which means that there are no credit terms. So how does COVID-19 affect the world economy? When we say that COVID-19 leads to a recession, it means that a country's GDP growth becomes negative, meaning that the total income of a country is becoming smaller. Companies typically make up a huge bulk of GDP generating income. When companies' business orders are affected, they make less revenue, and that directly contributes to the GDP shrinking. When companies find their sales orders dropping, they will slowly start to lay off workers to cut costs. That's why you find airlines all over the world with flights being cut. They will also cut their workforce. Otherwise, keeping a workforce that does not generate revenue for the company drains off the cash that the company has. So why are people being laid off? I am sure you have heard about how airlines are some of the worst, most impacted industries. Planes were being grounded due to COVID-19 as countries locked down their borders to prevent more COVID carriers from entering. Overnight, air travel came to a near standstill. Of course, rich airlines with lots of cash can survive for a longer time, but many airlines were close to being bankrupt. And since no cash is coming in from people buying air tickets, airlines will have to think of different ways to reduce cash outflow. And there are various methods to achieve this. One is to ground all the planes to stop flying. Another could be to sell away the planes so there are no longer maintenance costs. And of course, laying off employees. Marketing expenses to promote flights will also be reduced drastically. Some of you may be thinking, why not sell away all the planes, which are much more expensive than laying off workers, as well as saving on maintenance of the planes. Firstly, no one would want to buy the planes because other airlines are also facing the same problem, which means that they will not have the capacity to absorb more flights, more planes, so basically they will not buy the planes. Even if the planes could be sold, it will be sold at a huge discount. Secondly, when demand for flights pick up in the future, it is easier and much faster to hire people than to buy more planes. Inevitably, it becomes obvious that retrenchment or laying off workers is the first major cost-cutting measure that most companies will take. So what are the credit risk considerations that credit analysts have when evaluating the impact of the pandemic? This part will start to become slightly more technical. First, duration of the pandemic. Initially, many companies believed that the pandemic like the SARS virus of 2002 will pass in a few months with the coming of summer. This will mean the COVID-19 pandemic ending in June 2020 and the impact to companies' credit risk would be small. Typically, when credit analysis is done, some degree of economic stress in the near term is factored in. However, when credit analysts expect the pandemic to stretch on for 1 to 2 years, ending only when a large-scale viable vaccine is out, this would mean a surge in default rates by companies, or in plain terms, an increase in the number of companies going bankrupt. The general consensus now among credit analysts is that the worst part of the recession is over, which was in the first half of 2020, particularly in the months of April and May, when countries all over the world went into lockdown one by one. Recovery started since June 2020 because countries have learned to handle the pandemic and allowed for the resumption of most economic activities, meaning most companies are open for business. Therefore, we see that what most analysts thought to be a quick V-shaped recovery, that optimism has now turned into a longer, protracted recovery. The latest consensus appears to be a K-shaped recovery. This is a fanciful description of different segments of business recovering at different pace. Some industries will recover much more quickly than others. As you might expect, one of these would be the hospitality industries that belong to the segment which will see a much slower recovery. In credit risk terms, there is a widening gap in credit risk across regions and industries in the year to come. Impact on the various industries. Whether the company has many dealings with the impacted industries. If a company that caters food specially for airlines and the bulk of that company's revenue comes from airlines, then surely it will go bust together with the airlines, unless it is able to switch clients quickly to new industries. And that is why diversification of revenues is important, and credit analysis takes into account revenue concentration risk. The next thing to take into account are changes in government policy. As a result of the pandemic, we can see government implementing lockdowns, which means schools are stopped, people stop going to work in offices and factories, people have to stay at home except for essential services like seeing a doctor or buying groceries. While on the surface this situation seems mild, the impact on the economy is huge. For instance, railway companies once thought to be completely resilient to recessions see a complete collapse of riderships overnight. Restaurants and eateries go bust, hotels have zero bookings, so all factors are affected by government policy to some extent, and some sectors more than others. The next consideration are changes in consumer behavior. We saw that during the initial height of the pandemic, that people turned to purchasing goods and services online, rather than from brick and mortar shops. We also see people choosing to cook at home, rather than dine out in cafes or restaurants. There are less parties, less gatherings. So for instance, alcoholic beverage companies like Heineken, a beer company, saw its sales volumes dropping by 9% in April and June. And this is the case for a large branded beer company name. What about those smaller breweries? Can you imagine the extent of the drop of their sales? And most of the beer is actually consumed outside rather than homes. Now, what are the ways that a company can be affected by COVID-19 pandemic other than demand for its products dropping? Lockdowns were implemented in many countries. Let's look at what happens during a lockdown. Firstly, people stay at home. They are not allowed to go out except to buy food and other daily essentials. A car manufacturer like Toyota will shut some of its factories, wind down the scale of operations in its factories. Car showrooms are made to close, employees work from home, supply chains to factories are disrupted, such as the steel companies supplying parts. They are also made to reduce production to prevent the spread of COVID-19. Shipment of finished cars are delayed. From time to time, workers in factories may contract COVID, and parts of the production lines have to be shut down for cleaning. Workers that have been in contact with the patient will have to be quarantined, and this further slows down production. So this is what could happen during a COVID-19 pandemic. But how do we know what I said is true? Well, you can simply pop on to the companies of these websites. So on Toyota's website, this is what occurred during COVID-19. You can see that during August, July, and June, production volume fell by up to even 40% in June. And there were production line suspensions, there was reduction of operations from double shift in a single shift, so on and so forth. So a lot of all these public listed companies, they will actually show the impact of COVID-19, and that is how you can verify that this is exactly the breakdown of what happens to a company that affect their credit risk when COVID-19 occurs. High-risk industries that are most affected by COVID-19 include airlines, cruise lines, gaming, casinos, lodging like hotels, transportation, oil and gas. So high-risk industries means that the companies operating in these industries have a significantly higher risk of default than other industries. These companies will likely see their credit ratings being lowered more quickly and drastically, put on negative outlooks, because they would likely suffer from a severe lack of liquidity due to a collapse in demand for what they are selling. Simply put, the goods and services they sell are no longer in demand. Money does not flow into the company, and therefore they cannot pay their debts, they will become bankrupt. Sometimes, rather than saying that companies are bankrupt, companies would declare that they are insolvent, under administration, or under liquidation. Liquidation or writing out of a company is a process where the company's assets are seized and sold, with the proceeds used to pay off its debts and liabilities. Companies that are in the speculative grade ratings, like in the B or BB range, will have a higher likelihood of defaulting on payments during such severe economic stress. The impact of a pandemic is the recession that it is causing. These are usually the smaller companies that serve local markets, lack diversity in terms of geography or revenue sources. And because they are small in size, they also lack access to funding, such as getting more loans from banks or selling their shares on the stock market to get more cash. Therefore, these smaller companies are much more prone to defaults. Next, increase in debt leverage. In future videos, let us know if you would like to see more of such case studies of how real-life companies go into default and how credit analysis can pick up telltale signs 6 to 12 months before it happens. For this video, we will be less technical. One critical aspect as a result of the pandemic is that companies are going to increase their debt. They will borrow more from banks to finance their daily operations. The reason is that they cannot find the funds solely from selling goods and services because business is bad. So for instance, in an average year, a company like Ford can have 10 car factories to manufacture cars. However, when times are bad, not all the car factories are working at capacity. The problem arises because these factories were paid for using bank loans. Whether the economy is good or bad, whether the company is making money or not, they have to pay off their loan obligations to the bank. So companies can do so by raising funds from the stock market, negotiating with banks on the loan terms, also known as refinancing. Some companies have agreements with banks that allow them to increase loans when required, such as a credit facility. These are just some of the common ways companies increase debts or loans. When debt increase and their earnings fall due to the pandemic, this means that debt leverage increase. In other words, companies go deeper and deeper into debt. That's how a pandemic can kill a company slowly. Low-risk industries. These include healthcare, food and daily essentials, semiconductor, and even online gaming. These are some of the industries that can actually see improved sales revenue, higher profit margins, even during the current recession. For obvious reasons, they are in some sense benefiting from the bad economy. Take the food industry as an example. Let's say that we have an instant noodles manufacturer such as Nissin Foods Holdings. During periods of lockdown, companies like this found that people are stocking up on such food. The occurrence of dining decreases, and this means that households now increase demand for instant noodles. This drives up the earnings of the company. Therefore, it is very real that many companies are making more money as a result of the pandemic. What about gaming companies? Imagine game titles like Resident Evil, Monster Hunter that people can play online on PlayStation. These are industries that also see higher demand. People stay at home during lockdown. They have nothing to do, and one thing that they can do is to indulge in gaming. And it is a fact that gaming companies are seeing improved gaming revenues. Now we have come to the end of this first video. In the next session, we will be looking at exactly how the impact of COVID-19 is accounted for, all factored into credit analysis. So leave your comments and see you around in the next video.